Good morning, traders and investors around the world. Welcome to this Thursday, September 2nd edition of Pre-Market Prep with StockOdds. Joel Elconin joined by Rob Friesen here on this record-breaking Thursday as the S&P Index. Rob's not going to have to ask me to share my charts. I'm going to do it right away.
Yeah, you don't want me shouting at you.
At all-time high territory. Week closed yesterday. They shrugged that off, made a low just under yesterday's low, took off. We did make a new all-time high, folks. 42.25 was a high that you had. You went to 44, backed off about 10 handles, but regaining momentum here going into the 11 o'clock or 10 o'clock hour, 11 o'clock hour. Crude, you just can't trust crude. Looks like it was breaking down yesterday, back over 70 today, up $1.69. Gold having problems, man. Same area, 18.20, 18.25, fourth day in a row. Gold struggling at that area. Silver in the red by more on a percentage basis. That's down 35 cents at 23.87. Bitcoin, tired being outdone by Ethereum. That's up $1,800 at 50,120. Ethereum keeping its winning ways going. That's up 2.29%, $85.75 at 3828.75. So I am going to unshare here. I'm going to bring in Mr. Friesen, and we're going to talk about a couple things. The first thing is the end of the week. Right? We got the end of the week coming. We also can, maybe not today, but we can start thinking about the rollover in the futures contract coming over next month. Next week, where you start to roll over the contracts from the September to the December. We can talk about the mechanics of that. We'll probably do that on Tuesday. Well, I'm not going to be here Tuesday. Man, we're going to have to talk about that, Rob. And then ATR, which is something that I put in on my daily sheet every day, average true range. So, Rob, good morning to you. How are you doing on this Thursday morning?
Not too bad. Let me share my screen here.
Sure.
So first point out, I think it's imperative to understand, the volatility cycles. And how quickly volatility rises, but how short-lived it is most of the time. We've very rarely in history had prolonged periods, for more than a few days to a week or so of high volatility. I mean, obviously we've had some years where we had the meltdown and even last March, April, and volatility rose, but it's very short-lived for the most part. So here we are in a declining cycle again as we go into September, which is not unexpected for the first few weeks of September, kind of getting up to the third Friday, which is expiration. May see, volatility kind of decline until that point, and maybe that down day, if it happens as our seasonality says, that might spike it up a little bit again. Of course, there's always the chance for an incident to happen, right? Some event, some unexpected event. So again, I have to
hurricane. How about a hurricane?
Well, I have to reinforce the market factors in everything that it knows or can anticipate. That is why so much of the news is like a non-event, even if it's, a disaster like we've just seen. And yet the market rises, or it could be jobs numbers, or it could be, whatever. As long as it's somewhat expected, it's getting factored in ahead of time. What doesn't get factored in is the suddenlies, the surprises, like, aha, so there's, white swans, gray swans, and black swans. And you have to understand all three components, okay? Anyway. Sure. Moving on.
How about a pink swan?
So if we look at, okay, what was happening to, say, the VIX this morning, if you follow that. So we declined a little bit after hours. We declined a little bit more pre-market, and then we were kind of down at a fairly low level and we pulled up a little bit from that. So that's why we got our, choppiness out of the gate this morning. The VIX was kind of a little bit of a factor because we'd already declined quite a bit. So just keep that in mind. The way that the issues were presenting themselves pre-market is there was a lot of New York listed stocks that were actually, sort of not upticking pre-market. So I wasn't too concerned about my longs versus my shorts. I had curated a lot more longs today than shorts. So, it was looking okay. I'm down a little bit right now. The day, a lot of times when I'm down this much, sort of, like it's very slight, $150. It's not much, but by the end of the day, it could reverse.
Hey, what do you think? Is your SPY hedge is working against you?
Well,
What
see,
do you
that's
think's accounting for
the SPY hedge has been a bit too aggressive. And again, that these 6 stocks play into it, right? Like 22% of the SPY is comprised of 2 stocks, and it doesn't matter what they throw at Google in terms of news, it just continues.
Oh, we talked about
it continues to go, right? So at the end of the world, if you want to look fast forward to the very end of the world, I guess there's one company. I guess. I mean, that's what it seems to be happening. Oh, by the way, speaking of that, mergers, right? We have mergers announced. I want to kind of give a warning shot over there that this fall will be probably fairly heavy consolidation. And
Why?
Well, because the market has, risen so much. And if you look at the overall PE multiples, they're rising. So generally, when we get to this level of sort of maturity in the market, you see a lot more consolidation. And how you kind of know that the market's getting, fully valued or even overvalued is you'll see a lot more stock for stock transactions. When the market is sort of fairly valued or discounted, you see a lot more cash. Now we still see some of those now, but they'll have to, because the interest rates are so low, financing is available, lots of cash out there. It's not hard to come up with that. So you can still see a lot of cash deals, and that's non-dilutive then, right? But they have to take it in the form of debt. But normally, if you're managers of a company and you think your stock is overvalued, relative to other, your peers, or relative to where it's been historically, you might just say, let's take our stock and let's buy some assets, let's buy something. And one we've talked about before was the AOL purchase of Time Warner. I mean, the spectacular, right? Spectacular.
You love that, Rob.
I mean, honestly, that was the most spectacular merger I've ever seen in my life. But anyway, it didn't result in very good things for Time Warner. Ultimately, they had to write down a lot of goodwill, a lot of debt, a lot of other stuff. So, this fall, let's be mindful of the industries that might be the biggest takeover, in consolidation areas, right? So think about, where things have gotten really pricey. Mm-hmm. Think about areas where there's companies still that have like no debt on the balance sheet, like they're just debt free. They might be acquisition targets, something where, year over year EPS is just going insane. And if their market cap is small enough, they might be a target. We're seeing, I don't think we've entered a phase yet where you can really say the frothiness of everything has completely peaked. I don't see that. I just see that we're factoring in a little bit more risk. And so there's still a lot of these green shoots going to be occurring based on, again, the Fed's we've said that many, many times, right? I mentioned that I wrote about that, the allegory of, the Wizard of Oz was really about money and banking, follow the yellow brick road, right? And so that allegory kind of said, hey, the central bankers, they control money supply. So follow the Fed, follow the central bankers. Doesn't matter what country you live in, follow your central bankers. Yes, they're using some lagging indicators, but at the end of the day, they control money supply. So we have to, kind of not argue with it. So a lot of people want to argue with the market. Every time I've seen a massive bull market, we've had these long periods of low volatility and, constantly going up. I've seen people get stubborn and, short and to their peril generally. You know what I mean? Like, just don't argue with it. So like, hey, I would have loved to have, say 50 shorts and 50 longs today. But that's not what the data was giving me. The data was giving me more longs than shorts, so I went with the data. And so I'm not arguing with it, but we'll see how it plays out. There is some diversification, I've got Netflix long, CVS long, UAL long. So it's quite a mixture of stuff. KSU long, Discovery A long. So I'm very diversified in the choices. I'm not just like all in technology or all in industrials or all in oils or whatever. It's fairly diversified. Now the problem, of course, can be the ETF that you choose to hedge with, might be, sort of influenced by just a handful of stocks, and that can be a problem. So even though you have a nice diversified basket of longs, your short hedges can run away from you a little bit, right? So there's a thing you can do. You can actually trade in and out, layer in and out. We call it's just basically being a scale trader in the ETF, which can help you. So at the end of the day, if you ever do this, just evaluate your average performance on that scaling. So look at your levels. So one of the factors that's important to think about is this ATR. What is ATR, Joel?
Average true range.
But what is it really speaking of? What does it speak to?
It speaks to me on a daily basis what you can expect for moving in an issue from high to low.
So how it works, like if I took the IWM, which you could use to offset your Russell 2000 stuff. So let's scroll down here. ATR is 360, right? That's a 14-day average true range. And so $3.60 would be from the previous day's close. So you take from here, we have to allow this.
You do it from the close?
Well, yeah, because ADR, average daily range, would be only intraday consideration. Average true range is from the previous day's close. So here's how I look at it. Is the true range is obviously the formula, the high from the previous day, right? The low from the previous day, and the close, whichever the greater value is called the true range, right? So whatever the greater value of movement from yesterday is the true range. And then you take the average of that for 14 days, or if you like, we do it, we calculate it at 5 days, and so on. And that's available in this StockOdds web screener. You can actually download the single stock file here every day. It's fresh. And what that single stock file does is it tells you all of your ATRs on all your individual stocks that are in our database there. And you can get, VWAPs and all kinds of things from this, including average daily range and stuff. So I'll just move over to the days that we calculate here. So we have ATR on a 5-day, 10-day, 14-day, 20-day, 50-day, 200-day, and so on. So I like to look at the persistence of ATR and this Agilent's pretty consistent. The 5 days 254, 10 days 261, 14 is 254, 20 days 244, and the 50 is 232, and the 200 is 229. So, around that 230 to 260 area is going to be constant for Agilent every single day on average. So what ATR is a measuring stick of volatility, right?
Yep.
It's a measuring stick of volatility, and it's unique to each symbol that you trade, whether it's an ETF or whether it's a stock symbol, right? So it's unique to each symbol. So that gives me that measuring stick. So if I want to look at how much room does IWM have for the day, well, here's where it is. It's coming up to the top of its range. It has not been performing. The Russell has not been performing the same as, the Dow or the SPY or the Qs. But when you're looking at it in the day, it's getting, up to the top of the range. Okay, fine. But how much can it move? It's already up $1.67. Well, how much can it move? Well, from the close of the day before, 360 is the average. So there's plenty of room for it to move. Just that one thing can keep you out of trouble when you look at your, support and resistance areas. It can go through that like melted butter if it still, has 60% of an ATR left to run, right?
Yeah.
So use it as a measuring stick. One of the whether you're pair trading or anything, if you're basket trading, you can always look at, okay, well, FANG's doing pretty good for me today, so I could look at taking profit if I wanted when it hits a full ATR. That's always an option that I have, or I can stay in it till whenever. So you take a look at harvesting your levels, but acknowledging that ATR for each one of the symbols that you trade. It's just a really healthy thing. So I measure it this way. From the close, it could move up 360. But what if it dropped $3 right off the open? Well, then I'm measuring from the close down. It could still go down another 60 cents to be normal, right? And then you also have to add +1 or -1 standard deviation to that. So you got to say, it doesn't always move exactly one ATR. The average is what you see, 360 for the IWM. That's the average. So the average contains the outliers as well. So if you just have a rule of thumb to say one ATR ±1 standard deviation of that will give you the ability to harvest things on a normal basis, right? What's normal? Okay, what's not normal is when something moves past 180% of an ATR into 2 ATRs, 3 ATRs. That's not normal. That's a real outlier, but like how many occurrences of that are there? So what's the bell curve? Mostly, Joel, the bell curve is going to be sort of in this 60% of an ATR, to 80% of an ATR, right? With some outliers, but you'll have a lot that are in the 1 ATR to 140% of an ATR. So basically, the way I look at it is, if it dropped $3 and its ATR was 360, then I'm looking at the expansion of the ATR potential from the low of the day upwards, as well as it to give it room to move down, to another 60 cents. Does that make sense?
Yep.
Right. So you're always measuring your daily from the high of the day, or from the low of the day, or from the previous close. You're doing all three calculations quickly, like a super machine in your head, or you're doing it on spreadsheets or whatever, right?
So the way I've been using it, so My average true range for the S&P for today, the 9-day average true range is 34, correct? And we closed at 2150. So for me, how I've been using it is I come in, I see the low is 16 this morning in the S&Ps, and I'm probably oversimplifying it, but average true range from that 16, I'm adding 34 to that for my upside target today of 45.50. Is that not using it correctly, or a variation of
from the previous close? Yeah, if you're adding an ATR to the upside or downside.
Well, from the close, it would be higher than that. But I was actually doing it from because the close was 2150. So if I added 34 to that, that would be 54.50. But instead, I went from the current low of the session, which is 16. So you say,
yeah, and so both measurements are accurate.
Okay.
So the first one you do because it hasn't opened yet. So you can kind of map things out on, it could either go down an ATR or up an ATR the next day.
So I'm kind of using it right.
Yeah, no, that's fine. But when it goes down and sets
I learned
low,
something today.
Right? Then it might have gone down 50% of an ATR. So let's look at that. It went down 50% of an ATR. So from that point, what would be normal? Either go down another 50% of an ATR, or it could go up 100% of an ATR from that low, if that establishes, right? Let me repeat that.
Sure.
So before the market opens, you can extrapolate your up an ATR, down an ATR, right? From the close.
Correct.
But once we're in session, then you can measure it from the low of the day, if it's established. And at that point, let's say the low of the day is established at 50% down. That's all it went, and it starts to turn around, and your indicators all say blah, blah, blah. So from that point, down 50% of an ATR, it can move up 100% of an ATR. Or to be normal, it could go down another 50%.
Okay.
Right?
Yeah, the way I like to use it too is, when you see it, when I look at the S&Ps every day, you feel it, coming in, right? Coming in. And that's just kind of like my personal VIX. And, back in the day when we had, about a year and a half ago, 150, 200-point daily ranges, I kept on saying to myself, the volatility, this has got to come in order for the market to stabilize and go up. That has to come in. And that's exactly what happened. You went from like a 200 ATR. Now we're already down to 34 is where we're at. So, then you get to one or two, volatile days and it jacks it up. But it's kind of like if you're trading the same stocks or the same instruments, it gives you like your own personal feeling whether there's volatility, and also gives you reasonable targets, right? You're just looking to stay within the average. Yeah, there's going to be above average days where, a stock, kills it on earnings or something, but if you're looking for that every day, you're going to be left out in the cold, because averages are averages, and that's what they come back to.
So let's just roll through this, and I'll give some thoughts into how to establish a normal expectancy for your stock. Okay. So part of it is, where is the VWAP? We've got VWAP, 5 days ago, 10 days ago, 14 days ago. So you got those numbers as well, right? And then it's the ATR. And so that persistence, no different than if you were looking for, correlation persistence. It wouldn't be just, is something correlated with something else over 1 day or 2 days or 3 days? That's a pretty small sample. But is it correlated over the last 65 days and also over the last 250 trading days?
Okay.
Right? That's persistence of correlation. Same thing would be ATR. So for that Agilent there, it's persistent, meaning that it's very consistent. It doesn't jump all over the place, right? It hasn't had a rapid increase of ATR in the last the 14 days is the same as the 5 days, which isn't far off from the 20 days or the 30 days. So it's risen a little bit, but it's still in keeping. So it could revert back to its 200, which is 229, and it's at the 5 days at 254. So you might expect that contraction if volatility continues to go down. But that's how you look at it, the persistence of it, right? And the same thing with ADR. And with the average daily range, if you want to know how gappy a stock is, just take the ATR versus the ADR and you can see. So the ADR was 254 and the 5 day or the ATR was 254 and the ADR is 229, which is in keeping with its 200-day ATR. So my point is this, that difference between 254 and 229 is how gappy the stock is on an overnight basis.
Okay.
If they're the same, if ATR and ADR are the same, it doesn't gap at all, right?
Gotcha.
I know you got to go for
yeah. I just want to do one thing for Eric M. And Eric M, thank you for the questions on YouTube. And folks, any questions? That's why we're here. We want questions. We want to try and give you the best possible answers. I'm going to let Rob answer this one, and then we're going to wrap it up for today. Seasonality Almanac shows GDX and GDXJ have significant probability of being down for the month of September.
Right.
How could one use StockOdds to create a trade around this theme?
So what you can do is you can look at what the components are of GDX and what the components are of GDXJ. So GDX is the senior miners. There's been a consolidation in the industry, so not that many around anymore. There's a lot of junior miners still, GDXJs those. So you could look in StockOdds, and you can, in the symbols category right here, you can just type in the symbols that you want right in here. Just put in the symbols that you're looking for, and then go through, save the changes, then go through the various signals like RSI, %B, and come up with the symbols that are best representative of what you want to do. Do you want to be short GDX symbols and maybe, offset it with some long GDXJ, or the other way around? Or you just want to, be short some of both and then maybe long some offsetting basic materials somewhere else? So you can structure it however you want, but that's what I would do. Is I would look at the ETFs for that context, and then I would go into the symbols, and each day I would look for opportunity within those symbols. So if you know that the ETF is headed down on a probability basis, then you want the best symbols short within that ETF.
Excellent answer. All right. Coming up on 11 o'clock here, pre-market prep with StockOdds. All the information here is for educational purposes only. Please consult your own financial advisor before making any investing or trading decisions. Thank you all for joining us today. Be back at 3:30 with At the Close on the Benzinga channel. Just a quick warning, we will be doing all of our regularly scheduled programming tomorrow. Monday, of course, is Labor Day. The markets are closed, and Tuesday is the Jewish holiday. So there'll be no pre-market prep plus or pre-market prep with StockOdds on Tuesday. Folks, thanks for joining me, and be back with you tomorrow morning. Everyone have a great day.